SoFi Technologies is currently trading at $7.13 per share as of 10:45 a.m. Eastern Time on this Wednesday, January 14, 2026. The stock is seeing a modest intraday gain of 0.56% on volume that suggests institutional players are quietly absorbing shares, while the retail crowd remains split between exhausted frustration and blind optimism. While the surface-level movement looks like just another boring day in the fintech space, there is a massive gap between what the average investor expects to see and what is actually happening within the order flow. The common expectation is that SoFi is still just a student loan company trying to find its footing in a high interest rate environment. The reality is that the underlying business has fundamentally shifted into a high-margin technology powerhouse that the market is still pricing like a struggling regional bank. This disconnect is where the real story lives. Most people looking at their brokerage apps see a stock that has been stuck in a range for far too long. But if you look at the recent institutional activity, you will see a very different picture. Large block trades have been hitting the tape at a frequency we haven't seen in months, suggesting that the smart money is positioning for a breakout that the retail community is almost too tired to believe in anymore. The sentiment on platforms like Reddit and X is a fascinating study in human psychology right now. You have one camp that has been holding since the SPAC days, feeling the burn of every failed rally, and another camp that is convinced the stock is being suppressed by hedge fund manipulation and naked short selling. There is a palpable sense of anger in the comment sections of every financial news post about this company. Investors are tired of hearing about profitability and growth metrics, while the share price refuses to reflect those wins. This frustration is a contrarian signal in itself. When the retail crowd is this exhausted, it usually means the weak hands have been shaken out and the stock is coiled for a move. We are seeing a lot of chatter about short interest, which remains stubbornly high, leading many to hope for a massive squeeze. However, the data shows that this isn't just about a squeeze, it is about a fundamental repricing of risk. The market is finally starting to realize that the student loan narrative is a relic of the past. If you look at the daily swings over the last 2 weeks, you'll notice a pattern of aggressive morning selling followed by steady afternoon buying. This is a classic signature of institutional accumulation. Large funds often use morning volatility to hide their entry points, picking up shares from panicked retail traders who see a 2% drop and assume the sky is falling. The trading volume has been consistently above its 30-day average, which tells us that big players are actively fighting over this price level. While the retail community is busy arguing about whether Anthony Noto is a hero or a villain, the actual tape shows a battle between short sellers trying to keep the price under the $8 level and long-term conviction buyers who are happy to scoop up everything they can at these valuations. The macroeconomic pressure from the Federal Reserve has kept a lid on the entire sector, but SoFi is beginning to decouple from its peers like Affirm or Upstart. It is no longer moving in lockstep with the risky fintech basket, which is a significant development that many are overlooking. One thing that really gets under the skin of the SoFi community is the perceived media bias. Every time a major bank analyst puts out a neutral or sell rating, the social media threads explode with accusations of market manipulation. There is a deep-seated belief among retail holders that the big banks are terrified of SoFi's growth and are using their influence to keep the price down. Whether or not you believe in the manipulation narrative, the trading data does show some odd patterns in the dark pools. A significant portion of the daily volume is being executed off-exchange, which often happens when institutions want to move large blocks without tipping their hand to the public. This creates a lot of suspicion and adds to the emotional weight of holding this stock. People aren't just invested with their capital, they're invested with their pride. They want to be right and they want the establishment to be wrong. Before we go any further, I want to pause and get your take on the sentiment. Comment below how many shares of SoFi you currently hold and whether you are adding to your position at these levels or just waiting for a chance to break even. It is important to see where the community stands because that collective psychology is exactly what drives the volatility we see on the charts.
To understand why there is such a tension between expectation and reality, we have to look at what this company actually does versus what people think it does. The general public still thinks of SoFi as the company that helps you refinance your college debt. That was the entry point, sure, but the actual business model today is built on three distinct pillars that make it look more like a tech firm than a bank. You have the lending side, which is the old school bread and butter. Then you have the financial services wing, which includes the app, the credit cards, and the investment platform. But the real hidden gem, and the part the market is arguably mispricing the most, is the technology platform. By acquiring Galileo and Technisys, SoFi essentially bought the plumbing of the fintech world. They aren't just a bank, they're the company that other banks pay to run their own digital services. This is a high-margined, recurring revenue stream that should, in theory, command a much higher valuation multiple than a traditional lender. The reality of the situation is that SoFi has successfully navigated the death valley of fintech. They secured a bank charter, which was a massive hurdle that many of their competitors failed to clear. This charter allows them to use their own deposits to fund their loans, drastically lowering their cost of capital. While other fintechs are struggling with high borrowing costs, SoFi is sitting on a mountain of cheap deposits from its members. This is the structural advantage that isn't showing up in the share price yet. Investors are so focused on the headline numbers and the quarterly guidance that they're missing the long-term compounding effect of this banking license. It's like watching a sports team that has all the best players, but is currently losing the game due to a few bad calls. The talent is there, the strategy is sound, but the scoreboard hasn't caught up yet. Recent earnings reactions have been a roller coaster of sell the news events. Even when the company beats expectations on both the top and bottom lines, the stock often takes a hit in the following days. This is a classic sign of a show-me story. Wall Street is tired of promises. They want to see sustained GAAP profitability and a clear path to dominating the prime banking market. The retail crowd feels the sting of these post-earnings drops more than anyone. You see the posts on X about how the shorts are winning or how the system is rigged. But if you look at the balance sheet, the company is getting stronger every quarter. They're growing their member base, increasing the number of products per member, and diversifying their revenue so they're not dependent on any one segment of the economy. The institutional activity is where the real clues are hidden. We've seen several major hedge funds increase their positions recently, even as the price remains stagnant. These guys aren't looking at the 5-minute chart, they're looking at where this company will be in 3 to 5 years. They see a company that is eating the lunch of traditional banks by offering a better user experience and higher interest rates on savings. The expectation is that traditional banks will eventually catch up and crush SoFi. The reality is that the legacy tech stacks of the big banks are so old and clunky that it would take them years and billions of dollars to replicate what SoFi has built from the ground up. This is a classic innovator's dilemma. The big banks can't pivot fast enough, and SoFi is moving at light speed. The frustration among retail investors is also driven by the stock's high beta. It moves a lot, and often for no apparent reason. This creates a playground for day traders and algorithms, which adds to the feeling of manipulation that the community talks about so much. When you see a 5% swing on no news, it's easy to feel like the game is fixed. But that volatility is also the price of admission for a high-growth company in a transformative industry. If you want the stability of a utility stock, you shouldn't be in fintech. The people who are making the most sense right now are the ones who have tuned out the daily noise and are focused on the quarterly execution. They see that the company is hitting its marks, regardless of what the ticker says on any given Tuesday morning. Looking ahead, there are several catalysts that could finally bridge the gap between expectation and reality. The first is the continued expansion of the tech platform. If Galileo can sign a few more major enterprise clients, it will prove that SoFi is a legitimate infrastructure provider, not just a consumer app. The second catalyst is the eventual stabilization of interest rates. When the Fed finally decides to cut or even just stop the threat of hikes, the entire fintech sector will breathe a sigh of relief, and the companies with the strongest balance sheets will lead the rally. SoFi is at the top of that list. The third catalyst is simply time. The longer the company stays profitable and grows its book value, the harder it becomes for the bears to justify a low valuation. There's also the X factor of a potential buyout. While Anthony Noto seems determined to build an independent giant, the value being created here is hard to ignore. A larger financial institution or even a big tech company looking to enter the banking space could see SoFi as a perfect acquisition target. This is a common theme in retail discussions, though it remains speculative. The mere possibility of a buyout often puts a floor under the stock price, as shorts are wary of getting caught in a massive gap up. Retail traders often use this as a source of hope during the lean times, imagining a scenario where they get a 30 or 40% premium overnight. The reality, however, is that SoFi's path to success is likely going to be a slow grind rather than a sudden explosion. It is about winning one customer at a time, one direct deposit at a time, and one loan at a time. The expectation of a moon mission is what leads to the most disappointment. If you view this as a long-term compounder, the current price action is just a blip on the radar. The community's obsession with short interest and hedges is